All right, for more market analysis, let's welcome Ken Shinoda. He is a portfolio manager at DoubleLine, and he joins us in studio today. So, Ken, let's get to what we were just posing the question as, which is stocks added to gains, bond yields fell, gold prices rose, the dollar paired its gain. That was after the 2 p.m. decision. And then during the news conference, we saw more of the same. Why is the market seemingly relieved?
Well, I think stocks were very oversold. We've been seeing equity sell off for over 2 weeks. If you look at investor sentiment surveys, they were as negative as they were in October of 22, right, when stocks were down 20%. So we were overdue for a bounce, and Powell went straight down the middle of the fairway. And I think it was a little more dovish than people expected. He noted that, inflation is still a risk, but he didn't say that they would hike if inflation stayed persistent. He said that they would hold rates at the levels they are today, and if growth comes in slower, they have the ability to cut. And I think that caused a little bit of rally in fixed income, and it's going to help equities bounce for maybe a couple weeks here.
A couple weeks to bounce, okay. What did you make of the fact that the transitory word was brought up again? What kind of confidence does that give you in where we're going here?
They just love to pick on in with the transitory.
I know. Well, to be fair, he was calling it tariff inflation, and then there was a couple of words of transitory, but it feels like tariff inflation is transitory now. And
we saw that with the last Trump administration. We saw tariffs pick up in inflation on a one-time basis. But tariffs are deflationary globally in the sense that it can slow growth, and that's what the market's sniffing out right now.
So tariffs themselves may be transitory once they're put in, but what about constant threats of on-off tariffs that may persist over time, including over the next, 3 years and 10 months?
It's creating uncertainty for consumers. It's creating uncertainty for businesses, and that's one of the risks that's out there that could cause an economic slowdown, is that companies with this uncertainty will pull back on capital investments, will pull back on hiring, and so on and so forth.
There was also a lot of talk, a lot of time spent on the decision to slow down the balance sheet runoff, and how that was tied to the decision to, not decision, but the whole debt ceiling, confrontation we'll have later on this year. Is this the equivalent to a stealth rate cut in any way, or is this just something very technical?
Look, I think they're worried about potentially having some of those liquidity problems that we saw pick up in kind of like 2018 and 19.
The overnight funding markets.
Yep. So I think just kind of getting ahead of that, and we'll see how that goes.
What do you like right now in the market after all this is done? What do you like?
Look, I think European equities, they've had a great run. I think that the valuations are cheap there, and they're going to stimulate. So I think there's more room to run there. And then on the fixed income side, I think the risk of, going back to that kind of like 475% on the 10-year has diminished. It's pretty amazing. I mean, we were at 470 on the 10-year not so long ago. Yeah. And we had some calls from investors for 5% rates, 6% 10-year. Yeah. Where's it going to stop? Fiscal concerns. The fiscal concerns have seemed to have gone away, and I think part of that is because of this kind of slower growth narrative that's coming in the marketplace. So I think the longer end of the curve, I don't love the long bond, but I think longer duration, the risks to that upside have diminished. So if you get a backup in the 10-year back towards 450, I think that's a decent buying opportunity. We've been going up the credit curve over the last couple kind of months just because the credit curve was so flat, so you weren't getting paid as much spread to go from investment grade to high yield, for example. But spreads are starting to widen. So if vol kind of stays elevated and you see some spread widening, you can maybe get some opportunities in the credit markets too.
To that point, when you're talking about European flows, and we have seen money kind of move in there, does that come at the expense at some point of U.S. credit? And does that kind of move into other areas of the European market, for example?
It's one of the things we talk a lot about at DoubleLine is capital flows, and we've had this huge run of money coming into the U.S. Reserve currency being the U.S. dollar, and a lot of central banks buying U.S. assets, sovereign wealth funds outside the U.S. buying U.S. stocks, and what if that reverses? And I think a lot of that is in the equity market. You're already seeing some of that, but it could happen in bonds too. The good news for bonds is that foreign investment has been decreasing for years now, so I think it's less of a problem for the fixed income market.
In a world where nobody knows anything, and I think Chair Powell made that pretty clear when he said, 2 rate cuts, why not? What are the near certainties that investors like you can work with?
I think that we know that the bond market seems to be kind of fairly valued right now. I think most estimates by research people out there is calling for like a 425, 450 10-year at the end of the year. So I think there's a lot more certainty in fixed income than there's in equities. I mean, we've seen the reset in fixed income has been a rough couple of years, right?
Yeah.
So I would just be cautious on risky credit. You're already seeing this market start to kind of sniff out some concerns with like CCC, junk bonds, and things like that, and spreads are widening there. But people that have been underweight fixed income, it's probably not a bad time to start adding.
Ken, such a pleasure. Good to have you in studio. Thank you so much for joining Ken Shinoda over at DoubleLine.